Welcome back to Factful Finance, where we break down complex financial concepts in a way that's both clear and captivating. Today, we're diving deep into a question that's at the heart of global economics. What's the relationship between sovereign debt and financial stability? Now, this might sound like a dry academic topic, but trust me, understanding the intricate dance between national debt and financial stability can actually make or break your ability to understand global markets and your personal finances. So let's crack this open, step by step. Imagine a country. Let's call it Country X. Country X has been running a budget deficit for years, borrowing more and more to fund its public services and infrastructure projects. On the surface, everything seems fine. The economy is growing, unemployment is low, and there's plenty of optimism about the future. But behind the scenes, the government is accumulating massive amounts of debt. At first glance, sovereign debt doesn't seem like a bad thing. After all, governments can borrow at low interest rates, and debt seems like a tool to boost growth. But here's the kicker. As sovereign debt climbs, so does the risk of financial instability. Let me explain. When a country's debt gets too high, investors begin to worry about the government's ability to pay it back. This leads to higher borrowing costs for the country, which creates a vicious cycle. Let's break it down with a real-world example. Back in 2010, Greece found itself in this very situation. Their debt-to-GDP ratio soared past 140%, and the markets began to panic. The result? Interest rates on Greek bonds skyrocketed, making it even more difficult for the country to manage its debt. What followed was a full-blown financial crisis, threatening not only Greece's economy, but the entire Eurozone. This is what happens when sovereign debt reaches unsustainable levels. So, how does sovereign debt actually impact financial stability? Well, the relationship is complex. Financial stability depends on investor confidence, the ability of governments to manage debt, and the overall health of the banking sector. If investors lose faith, capital flights can occur, triggering a devaluation of the national currency, an increase in inflation, and even social unrest. You don't need to look any further than recent headlines to see how important this is. But here's the thing. Sovereign debt can be a tool for development, especially if used strategically. When a government borrows wisely, focusing on investments in infrastructure, education, and technology, that debt can spur economic growth, leading to higher tax revenues and ultimately a stronger financial system. But if the borrowing isn't carefully managed, if it's spent on projects with low returns, it can backfire, leading to a debt spiral. Now, let's add some numbers to make it real. According to the IMF, global sovereign debt has hit record levels in recent years, with advanced economies leading the charge. But it's not just the total amount of debt that matters. It's the ability of the country to service that debt. Countries like Japan have enormous debt, but also have strong economies and low borrowing costs. On the other hand, emerging markets with weaker economies, like Venezuela or Argentina, face much higher risks due to their inability to manage debt sustainably. In practical terms, for you and me, this is about understanding risk. When a country's debt reaches critical levels, it can cause ripple effects in the global markets, impacting everything from the stock market to interest rates on your mortgage. So when you hear about sovereign debt crises, don't just tune out. These events have real-world consequences, whether it's through currency fluctuations, higher inflation, or even the stability of your retirement portfolio. What's the takeaway here? Sovereign debt can play a critical role in shaping a nation's economic future, but it's a double-edged sword. Effective debt management is crucial for maintaining financial stability, and mismanagement can lead to financial chaos, not just for governments, but for everyday people like you and me. So the next time you hear about a nation's debt, remember, it's not just a number on a balance sheet. It's a critical factor in the global financial ecosystem, and understanding it is key to understanding the broader economic forces that shape our world. If you're interested in more of these deep dives into financial economics, don't forget to like and subscribe. You won't want to miss what's coming next. And if you have any questions or thoughts on today's topic, drop them in the comments below. I'll respond to as many as I can. This content is for educational purposes only. Always consult a certified financial professional for personalized guidance. If you found this video helpful, there's plenty more where that came from. Watch the next video on screen to continue your journey into financial mastery.